Greetings, investors. This session is going to take a closer look at the company Stryker, ticker symbol SYK. It's one of our continuing series of stock blasts where we take a look at stock study highlights of a variety of companies. And in this case, we're going to be looking at a medical device leader, although I think they would make the case that they're simply out there trying to make people's lives better and hospital experiences better, and simply just better across the board. My name is Mark Robertson. I am managing partner and founder of Manifest Investing. You can see that the contact information at the bottom of the slide in the middle. You can, if you're a Twitter person, you can follow me at Manifest Invest, and you can also use the email address there, markr@manifestinvesting.com, if you have any follow-up questions or things you'd like to see discussed. In fact, if you want to suggest a company for this type of session, we'd love to hear it. And you can also request a copy of the PowerPoint slides. So with that, let's go ahead and get into taking a little bit closer look at Stryker. Again, to keep the legal beagles happy, no investment recommendation is intended here. This is simply an educational demonstration where we will share some of the methods and processes that we use at Manifest Investing, again, consistent with the community of long-term investors in the modern investment club movement. And again, do your own homework. Stryker's kind of fun. It is the most widely followed stock by our community of investors. It's ranked #1 in what we term the Manifest 40. These are our 40 most widely followed stocks according to the dashboards that are maintained by our subscribers at Manifest Investing. And Stryker has been there for a while. It's been in place for quite some time, and remains a community favorite to this date. One of the neat things about the Manifest 40, we do follow it as a tracking portfolio, and we have witnessed fairly strong performance. That's basically a 490 basis point advantage to the Wilshire 5000 over the last 6.5 years. So you can buy and hold for as long as it makes sense to do so, high quality companies. Again, the results are formidable. As a reminder, we basically characterize investments by two major factors, the first being the return forecast, which we characterize as the projected annual return, or PAR. Then we take a look at some of the core characteristics that most of us would intuitively associate with quality for any company: financial strength, stability of results, consistency, and then again, competitive comparisons when it comes to growth forecasts and profitability forecasts of any company versus its peers or competitors. And always a good thing to keep all of that in mind continuously, and we do that with a quality rating at Manifest Investing. Here's a closer look at the business model analysis for Stryker. Again, we're taking a look at the top line sales over the years. You can see a little bit of a downdraft here during the recession back in 2008, 2009, but a fairly steady picture despite all the pressures in the healthcare with the legislation and the stuff that is being kicked around. We basically see a company that could literally grow somewhere in that 8% range going forward. And that forms this longer term trend line for top line sales. We basically take a look at the profitability of the company to build out the earnings per share forecast. You can see that the more recent updates from finance.yahoo.com have been pretty consistent. No changes over the last literally quarter. Pretty solid situation. Again, a condition that many of the people in our community would refer to as an up, straight, and parallel situation. Generally a core characteristic of a high quality company. Here's a look at the profitability analysis. Again, we measure it by percent net margin, and again, it's a picture that has continued to improve over the last several years despite a number of pressures, including a changeover in management. We had a changeover in CEO a few years ago, but appears to be stabilizing, and even with the analyst consensus forecasts for 2012 and 2013, again, stabilizing and perhaps diminishing returns at work here a little bit, but somewhere in that 17 to 18% net margin for the longer term projections. We take the sales growth forecast of 8% or so and apply it to with a 17% net margin. We got one more thing to go and get, and that's the projected annual PE ratio, and we look for the average, and you can see that this is something that has been coming down to earth over recent years, going from left to right. The 3 to 5 year forecast according to Value Line is 15. Taking a look at some of the other sources we look at, 15 seems to be a fairly reasonable number. So from the current day income statement to the 5-year projected income statement on the right, we basically see a company growing at 8% with net margins in the 17% range and a PE forecast of 15. Literally, those 3 core milestones of analysis deliver a stock price forecast of somewhere in the neighborhood of 80. The company does pay about a 1% dividend yield. So we're talking about a company that's in what we'd probably characterize as a hold or a weaker buy situation at a projected annual return of approximately 10%. To give that projected return a little bit of context, here's a look at the longer term picture for the company. Again, one of the neat things about it, this is about 12 years of quarterly results for Stryker. You can see the forecasts according to the value line. Again, that low total return forecast from value line, ranging from left to right. You can see that the stock price has had a fairly healthy trend with a couple of surges and dips in it. Let's talk about the strongest buying opportunities first. That happened back here during the Great Recession when literally the projected low total return from value line zoomed up into the upper 20s. So this was a buying opportunity. If you focus on return instead of stock prices or the panic going on all around you, and next time we get one of those, you'll know what to do. In this case, latching on to Stryker down in the low 30s has turned out to be a pretty good idea. It basically has peaked out here fairly recently. The fundamentals still continue to improve on a relative basis, but you can see that the low total return forecast, at least according to value line, is down a little bit closer to historical lows. So it could be the type of situation where if it made sense within the context of a portfolio, that we could see some of the people within our community perhaps lightening up a little bit on the Stryker. But other than that, still a pretty good long-term hold, considered by many within the community to be quite a core holding. Here's a quick comparison of some of the various resources out there. You can see the major characteristics. Again, not the top of the pack, but there's nothing wrong with a 10% return, 10% projected return. We're a little bit more optimistic than Value Line is at their 5 or 6% low total return forecast. You can see basically the formation of that with all the characteristics there on the left-hand column. Pretty strong consensus on profitability going forward. Some of the other major research services have a little bit lower expectations. So do we, based on looking out at that longer-term forecast. Again, valuation mid-teens. All in all, pretty good picture for Stryker. We'd basically consider it again a strong hold, perhaps even a weak buy. But again, depending on the context of the overall portfolio and how it fits in. But all in all, A's across the board, pretty good report cards, neutral conditions, the Caps All-Stars like it. All in all, pretty good picture for Stryker. Hang in there. Take care, everybody.